The bull run might be coming up any day now. And luckily, I have been able to watch hundreds of wallets through the app I built called Stack. And I have seen some things that I think most people need to understand to take full advantage of the next year and decades in the crypto space. So my name is Miguel Sanchez. I'm the co-founder of Stackit.ai. And thank you for watching my channel. Most people are not going to make it in this bull run. And that always happens. If it's your first time, second time, depends on where you are in your crypto journey. Most people mess up the first time. And if it's your second time, it's possible you mess up again. But I'm here to let you know what I've seen personally, what I've done wrong in previous bull markets, and what I've seen people do right and wrong over the past 2 years with hundreds of wallets using my app. First off, this is not financial advice, right? Like, one of the things I want to make sure I am super insistent about is that this is all potential. And of course, we're all in crypto and in investing for the potential it could bring us. But none of this is financial advice. I'm telling you what I've seen and what I've done, and you get to choose how much you want to copy what you've seen, what you've heard, or not. And again, Stack as an app is not a trading platform. We are a dollar cost averaging platform. So our gains are not based on our algorithm swaps and timing the market. It's about dollar cost averaging for the long term and borrowing to live. That's our goal with every one of our customers, to have them dollar cost average for long enough where they can borrow to live the rest of their lives. Stack basically helps you borrow and not worry about liquidations. So the overall idea is borrow more now while Bitcoin and Ethereum are these prices, so you own more later when the prices are hopefully higher. But there's no guarantees. And of course, if you don't want to watch the whole video and you just want to learn more about how to do this, there's a link in the description, or you can go to stackit.ai/guide to learn more. All right, so the bull run setup is here. We're in this amazing time where the Bitcoin price seems to be holding above 100K. Ethereum seems to be on the verge of breaking out. Countries, companies, governments are buying Bitcoin. The biggest wealth managers in the world are buying Ethereum up like candy. Regulations that we were worried about not ever happening are starting to happen. This week, the USDC, stablecoin bill got further and further down the voting line. So we may be in a time where all of this hits at the same time. So you could either react to what happens or prepare up front. And luckily, again, I've been helping people prepare for this for years, and I've seen what they do right and what they do wrong. So here's the major 3 lessons I've learned by watching these wallets that use my app for the past 2 years, but also even seeing these mistakes be made before I built the app. So the first thing is consistency. At the end of the day, everything is about consistency. If you just go to the gym one time, you can't expect to be healthy. If you just eat right one day, you can't expect to be healthy. If you invest every now and then, you can't ever expect to get rich. It's just not going to happen. But the opposite is totally true. If you eat right every day for a long period of time, there's almost no way you're not healthier. If you work out every day for a long period of time, there's almost no way you're not healthier. If you invest on a consistent basis for years and years and years, there's almost no way you don't become rich. And again, it's not financial advice, but look that up. It's just common knowledge. And the problem is most people are not able to do it for multiple reasons. One, they just don't have the capital to do it. And a lot of times that's most of the reason, but it's not all of the reason. The other reason is they just can't be consistent because they forget, because everybody has 20, 50 extra bucks that they could put towards investment every month. They just can't remember to do it, and they just choose to put their money in other places. And that could cost you millions of dollars, as you will see as you watch along. So the first thing is you got to build a consistency in your investing. However you do that, with us or without the app, you need to figure out how much a month you can put towards your future investment. And I know another thing comes up a lot is, hey, Miguel, I don't have thousands of dollars every month to invest. So it doesn't even make me feel like I should do it. Because if I only have 50, $100, what is that really going to do for my generational wealth building? And as you watch further along, you will see why we built Stack and how you can make dents in your wealth building, like with hundreds of dollars or less, 50, 100, $200. You'll see. The second big mistake I see, or thing I see people do good, is either take advantage of the volatility or not. So here's a breakdown of stuff I've seen in using my wallet, and I did it in the first bull run. So we all been there. If you've been an investor, the price shoots up and you watch it go up and you're like, oh my God, I'm rich, or I'm much better off than I was before that rise. But you don't act. You just watch the price go up and you watch the price go down. And that is not taking advantage of the volatility. If the price goes up 25% in a week or 2 months or a year, and you don't take that profit and the price comes back down, you didn't take advantage of the volatility. Because the opposite is true as well, right? You could have put in money at a time when the price falls. And if you are not watching and protecting that loss, you will lose money. A lot of times, and this is another big part of being consistent, most people only put money in when the prices are the highest. So in seeing the app, that's probably one of the biggest things I've seen, because I have high net worth individual, multi-millionaires using this, and I have retired people just trying to make sure that they have money to live using this app. And all of them, without fail, if they don't set an auto deposit, they all put in money when the prices are the highest. Hardly anybody puts in money when prices are low. So that's like going to a store and not buying when things are on sale. It's like walking into whatever your favorite store is and saying, ooh, things are on sale today. I'll come back when they're back to the high prices. And that's what people end up doing. And I guess at this point, I'm not even trying to change that. One thing I did in the beginning was I tried to change that by combining investing with a bill. And I still kind of am doing that. I'm saying set an amount every month and treat it like a bill. Invest every month that much. But you'll see why the little bits that you may feel like is not enough to invest can become a lot more. Then this is where, if you put $100 and you can borrow more to buy assets, which is what the wealthiest people in the world do. If you look at real estate is the biggest culprit of this, and not even business. Think about it. I'm a person. I see this real estate property. I want it. But it costs $500,000, $1 million, whatever it is. Most real estate investors do not have $1 million or $500,000 of cash. They go to a bank and the bank gives them 80% of that property's value. You put down the 20, the bank gives you 80. And what do these people do? They grow the value of that property while they pay down the loan, and then they're, over time, net worth rich, millionaires, billionaires in some cases. So it's the same idea with Bitcoin and Ethereum. Right now, Bitcoin is worth $4,000. Ethereum's worth about $2,500. If you could borrow, let's say, $10,000 to buy that now, and in the future Bitcoin gets to $1 million a coin, you benefited from borrowing to buy that right now. And that's the whole point of this. Here's why the best stackers beat the market timers. Because they're consistent. People who think they can time the highs and the lows almost always lose. I've had a few people I've seen do it well in the app and in talking to them. They are professional traders though, like all day, every day. This is what they do. So, and even some of those people don't time it right. So if you're not going to sit and watch the charts all day, every day, 7 days a week, why even try to time the market? I don't know why anybody would do that. It's up to you though. If you think you can, Stack is a good place for you to do that because you have the downside protection, and that's why they use it. But technically, I would tell you, the best people are the people who just consistently deposit money and go about their day, building their businesses, working their jobs, living their lives. Because trying to time the ups and the downs randomly, which means you mostly put in money when you have FOMO because you think the price is going to go to $1 million tomorrow, you end up losing. It's almost better to have a small amount put in over a consistent amount of time than putting in a big amount in one shot and not coming back. Because what I've seen is most of the people that put a big amount, they put the big amount when the price is the highest. So then the prices fall on them and they lose because we have to protect them. But they don't bring new money in. They're not consistent. So we have to continuously build back up. And that's harder to do with less money, right? Because if you put in money when it's 110 and the price falls to 78,000, that's a big drop. And now you got less cash because we need to protect you. So now we are starting to have this growth protection, which what that does is if the price goes up, you have to choose something to do. You either have to take the profit, repay loans with that gain, or a little bit of both, because this is something, it's very hard to do as a person because you get the emotions of, wait, I think it's going to keep going up, but I don't want to sell. But if you let automation and robotics and AI deal with that, there's no emotion there. It will just do what it needs to do when it sees what it needs to see. So these are the three types of people that I've seen stack the most. People who are trying to take advantage of spending money. So for instance, every week we all spend money. And if I know this month I'm spending X amount of money, I want to spend a little bit to make sure I'm investing. So there's some people who say every week I'm going to send X amount to my wallet. Some people will say every month I'm going to send X amount to my wallet. And those people, even in a bear market, are just bringing money in. And those people, especially in the bear market, are taking the most advantage. Because in a bear market, the price is low for the longest period of time. So if you're bringing in money consistently while the prices are low, you end up making a lot more when the prices grow. So this is where people who were using it when the prices were low, they are doing amazing. And again, there's some people who caught great timing and they're still okay, and brought in only once, right? They brought in at a perfect time and it worked out. But most people tend to bring in when the prices are the highest. Another type of user is a business owner who just hasn't saved enough for retirement. And that was me. That's why I built Stack, actually, because I worked for many years, millions of dollars went through my hands, and I didn't save enough. And I didn't invest enough. And now I need to catch up. And luckily, we have this asset class that is the fastest growing in history. And there's this way of borrowing at low interest rates with no recourse and all of that. So it just allows me to get more assets now than waiting till I can actually afford to buy them, just like real estate. And actually, one of our biggest user bases is real estate developers and investors, because what they see is they can deposit money in here, borrow to spend. So what they'll do is they know they're about to buy a property, and let's say they're about to put down 20%. They'll put in, let's say, 100,000 here, borrow 50, put that down on the property. Now they got $100,000 of Bitcoin and Ethereum, and they got the $50,000 deposit to put on the property that they're able to buy for, let's say, $200,000 or something like that. And now they have Bitcoin, Ethereum, and the real estate property. And that is a huge way I've seen people use Stack. So why do we say use your money twice? You'll hear me say that a lot. Use your money twice, use your money twice. That's what the rich people do. Richest people in the world don't use their money once. They don't get paid and spend it. They don't take their money and then spend it all on investments. They'll use it as a down payment and borrow money to buy assets. And yes, once you get to a certain level of wealth, you can just buy the assets straight up. But at the end of the day, most people are not starting there. I do have a few people that do that too. But again, that they've reached a level of wealth that most people are not at. And the way that you stack is really simple. You basically set up a automatic deposit every month or every week, whatever you want to do. You set it in your own bank account. The app does not pull money out of your bank. You set it to say, okay, every week I want to send $25. I want to send $50. I want to send $100. I want to send $500, depending on what you can do. Then you look up and we automatically deposit that, borrow however much you set in the app. Right now 40% is the default, and we have to stick with that for a little while, but we will be growing that. And then for every $100 you deposit, we can borrow $250. If you deposit $200, you can borrow $500, and goes on and on. Then we dollar cost average into Bitcoin, Ethereum over 30 days within your deposit. So if you deposit on the first, throughout the next 30 days, we will be buying Bitcoin and Ethereum for you. The reason we dollar cost average is because what I spoke about in the early part of the video. Prices go up and down. You may be putting money in when the prices are the highest. So you want a dollar cost average so you can ride those ups and downs. And then what Stack does is if you can set how much of your net worth you're willing to let fall before you start protecting the wallet. So let's say you got a $10,000 net worth and you say, I will only let my net worth fall 10%. And when the net worth falls that 10%, we will start selling some of your assets to protect that 10% net worth drop. You can set it to be lower, and that will mean we sell less, but it also means your net worth can fall a lot more. And there's a pro and con to that. There's no silver bullet, but I believe it's better to protect net worth than let too much volatility happen, because we don't know when the end of the bull run is. So you might happen to have a very high profit, and then in a few weeks, all of it is gone. And I live that life, and most of us live that life. So that's why we set the protection to be automated. You don't have to think about it. You set it and forget it. And here's why protection matters. Overall, it's much harder to gain money back after you lost it. So here's something you could also look up. If you lose 50% of your net worth, it takes 100% gain to get it back. So when you do that math, you want to limit how much your net worth falls, because then you don't need to grow as much to get it back. So if you're only letting the net worth fall 10%, you only need 20% to get it back, and then some, right? But if you lose 50% of your net worth, you need it to double to get back. And that's where you want to take advantage of that. And yes, it's better to sell when the prices are up, because then you can dollar cost average when it comes back down, and that's buying more on sale, right? And the ultimate, Einstein called it the eighth wonder of the world, is compound interest. So if you're compounding this growth over years and years and years and years, and you're depositing consistently into whatever asset you want, whether if you do it on any app or you just dollar cost averaging, that's going to be better than anything. What I do tell people is, if you're not going to be consistent, you might not want to use Stack right away until you know you can be consistent, because, we're just going to have to protect your loan. And if you don't put money in consistently, when prices fall, your assets are going to fall quicker than if you are consistent, because you'll always have dollar cost averaging in, even when prices are falling. So this is something I've seen over the past few years. And this is what I meant about how much you can bring in. So let's say you can only bring in $25 a week. That means you could turn that $25 into $350 invested. So like $400 a month can turn into $1,400. And let's say you can't even do that. Let's say you say, look, I can only do $25 a month right now. My bills are crazy. I don't even know how I'm going to do it, but I need to do something. If you bring in $25, you can borrow more on top of that and create more wealth, right? So this is where my idea is, if real estate people are borrowing to gain wealth, why can't we with crypto? The only reason you wouldn't is because you're afraid of volatility and being what's called liquidated. But that's what we protect against. We protect against the volatility going so down that you lose by paying off your loan quicker than you wanted to. And that's all just a liquidation is. It's repaying the loan with the collateral you have. So technically you're not really losing money because you're repaying the loan you took out, right? Yes, the price goes up and down. And in that moment, yes, if you had 100K and now it's 80K, you could consider that a loss. But you only lose if you just sell it all. If you wait till the money comes back and the value grows again, you didn't really lose that money. So that's why just be consistent for a long period of time. It's almost impossible not to get wealthy. And this is a big thing you need to understand. Like, just being in the bull run one time is not enough to get rich. Like, if this is your first ever bull run, don't expect to be rich after this. You could be much more wealthy or much more better off financially, but you're not going to be a millionaire. Don't even go for that unless you have hundreds of thousands of dollars to deposit and watch grow. You're not going to be a multimillionaire by bringing in $1,000, $10,000, $50,000, even $100,000. You can't expect to be a millionaire in one shot, in one bull run. You need to bring in a good amount of money, and I'll show you how that works on a compound interest calculator. So if you go to investor.gov and go to or just search compound interest calculator, you can easily find this. And now, let's say you were going to invest $100 a month. And you were able to do that for 30 years, which again, I told you, it's about being consistent for a long period of time. You can't expect to put $100 in one time and be rich. 30 years sounds like a long time, but when you think about it, I'm 46 right now, which is pretty old. And that makes me 76 years old if I'm able to invest consistently for 30 years. And now the life expectancy is higher than 76 years old. So if you're younger than me, I'm 46, you got more than 30 years. Even if you're older than me, the life expectancy is like 86, 87 right now. So you got another, even if you're in your 50s, you got 30 years. And with AI technology, we may start living longer. So if we start living at 120 or even 110, that means even if you started when you were 80, you got 30 years. The only question becomes, are you going to have consistent income for 30 years? That is a valid question. That's why I'm actually putting more than as much as I can in here, because I don't know what work looks like in the next 30 years. But hopefully there's still work and we can do this. So now I'm going to take a very conservative 15% a year interest, and that might be a lot. And because of that, I'm going to take a 5% variant here so you can see what that looks like. So, okay, for 30 years, if you just invest $100 a month, you get to 500 grand. And with a 5% variant, that could be on the higher end. Like if it goes to 20% a year, Bitcoin and Ethereum growth, that means you get to $1.4 million over 30 years. You could retire off that. And again, there's other factors like inflation. There's, not financial advice. This could possibly not happen, right? So again, you got to put yourself in a position to potentially benefit off of something like this, but there's no guarantees. That's just $100 a month. Now, if you stack it, instead of just using the 100, you can get to $350 a month. And now we take the same amount of money and see what happens over 30 years. Look at that difference. 1.8 million, and if it's 20% a year, it's almost $5 million. If you just put $100 and borrow $250 extra for 30 years to buy Bitcoin and Ethereum, dollar cost average, and it grows 15% is 1.8 million, 20% is almost 5 million, and 10%, which that would be like the stock market now, 690,000. So this is where, depending on where you are in life, this may not seem like a lot, but it's very different than having nothing. And this is something I'm very scared of, and I see it happening already. I see people retiring with nothing. Even when you have a real estate property, you can have a real estate property, but if you don't sell it, you can't take advantage of that value, because once you retire, the bank won't lend you money against the equity of your home. So the only way to get that equity out is to sell it. So this is where with crypto, there's nobody that can tell you, no, I want to borrow money today. I can, but you just want to be careful, right? But if you got to $1.8 million, you can borrow, right? Again, hopefully you weren't over borrowing over those 30 years. So that's bringing in 100 and borrowing 250. Now let's say if you brought in 200 and borrowed 500, making it 700 a month, how much does that become? 3.6 million at 15%, almost 10 million at 20%. And the truth is, most people believe over the next 30 years, Bitcoin will grow 20% a year on average. That's what most people believe, not financial advice. I don't know what is going to happen, but I'm hoping that's true. I'm hoping it's more. We'll see. If it's 15%, that's still 3.6 million. That's okay with me, right? If I'm bringing in $200, turning into 700, and for 30 years, I'm just investing $200 a month, and I have 3.6 million, sign me up, right? And of course, if it's only 10% a year, that's still $1.3 million by only putting $200 a month in. And yes, 30 years is a long time, and most people are like, I can't even think about 30 years. Yeah, well, once you get there and you didn't do something like this, you're going to kick yourself. And that's what's happening in America right now and around the world, because everywhere in the world, people can't just invest for retirement. That's not even a thing in a lot of countries. But again, it's about consistency and putting in something every month to reach these numbers. And now I'm going to get to the bigger numbers of people that are really serious about this. So let's say you borrowed $300. You brought in $300 and you borrowed $750. You can invest $1,050 a month. And now these numbers start to get ridiculous, right? Like $14 million if it's 20% a year, 15%, $5.5 million, even 10%, $2 million with $300 a month. And of course, I'll stop after this one. But if you bring in $400, you can borrow $1,000, and the same calculation, $7 million, which I know that sounds crazy, almost $20 million if it's 20% a year, and if it's only 10%, 2.7. So this is where, like, there's no silver bullet. There's no, hey, I'm gonna put my money in this and tomorrow I'm rich. That's gambling. If anybody tells you that, yeah, use this and in a year you'll be rich, just don't believe it. Figure out what you're willing to invest in consistently over decades. For some people, that's real estate. For some people, that's stock. For me, I just feel like crypto will grow more than stock and is more freeing and able to use than real estate. And here's why wallets fail. First of all, I've said it over and over again, the first worst way is not being consistent, right? If you bring in money once, you have to be like, that's like lotto. That means you have to hit at the right time. You bought in at the right time. The price goes up and up and up and never hits below where you put in ever again. And that's pretty hard to do. Like if you're buying right now, I don't think you've caught that timing. Maybe 2 years ago, maybe. And I only know like a few wallets, like 2 or 3 wallets that caught that kind of timing. Second, you don't take profits when the prices are up. So right now in the app, we're adding to this growth protection, which means you have to choose something. You have to either take profits or repay loans when prices are going up. That's the only way you're going to take advantage of the volatility. So we're automating that for you because most people just don't do it well. Very, very, very few people. I would say 1 or 2 on the platform were able to do that well out of hundreds, so the percentage is so low, it doesn't make sense. The second thing is over borrowing. And I was a victim of this in my first bull run. Once you see your value of your property, and Bitcoin and Ethereum is property, just like real estate, grow. Like let's say you were lucky enough to dollar cost average for a long period of time, and now you have 100,000, and Bitcoin goes on a run, and now you have 170,000, let's say, and you got a 50K loan. Now you see, wait a minute, I can borrow. I have a big amount that I have a big amount in my net worth. Let me borrow. And what ends up happening is you borrow more. And now that brings up your loan. And now when the price falls, we need to protect it. So we need to sell some of those assets because we need to protect that net worth. And because you borrowed so much, we need to protect it sooner than you would have to. And that's where I've also seen wallets go bad because they over borrow. They bring money in every time they see prices hike, they borrow more. And then when the prices fall, we have to protect their assets. So we have to sell some, and now we got to sell more because they took out more loans. So that's a big deal. And I tell people, try to treat it like whole life insurance, where they say just dollar cost average into your whole life insurance for years before you think about taking money out. Actually, some life insurances, they don't even let you borrow unless you're consistently putting in money for 10 years. And that's probably because of what I'm just seeing now as well. So if Stack is something you're interested in doing, it's very easy. First, there's a link below in the description. Watch our 3-point guide on how to get 3 times more Bitcoin and Ethereum, and then we'll jump on a call and I'll show you how to do it. I like to jump on calls with our customers, me and my employees and my support staff, because I like to show people the right way of using it and get questions and feedback in real time. That's how you build a company. Because right now, as a founder, you have to build an audience, a community, and a product at the same time. So I like to really talk to my audience and community about the product. So what you want to do is you want to start with a reoccurring deposit. And the way you do that is you connect your bank account through Plaid. You basically connect your bank account and you say, okay, every month I'm sending this amount to my retirement fund or my investment fund. And it's like a bill. You set that amount and you just let it do its thing every month, and it lands in your wallet, and then Stack automatically does what it does. You could begin with something like $50, $100 a month. If that's too much for you, you could begin with any amount. You could begin with $10, $5. This is available to anyone, anywhere in the world. I built this in a way where if a person in a poor country only has $5 a month to invest, they're still going to invest more than not doing this. And then with the $50 or $100, you can borrow another $125, and now you're investing $175 from just depositing $50. So how many people can invest $175 a month? Not many people around the whole world. But with $50, you can. Just like real estate, you're borrowing to buy more than you can afford. If you could go up to $100 a month, you'll be investing $350 a month. And as you saw in the compound interest calculator, that could turn into a lot of money. And if you want to learn more about how much Bitcoin you would need to be financially free, watch this next video.